From what you're saying, it sounds quite positive. As you said, most of the equity gains have probably already been had, but there's still that 1/3 in certain industries which are probably going to be available for the average person. Okay,
Correct.
that makes sense. And then if we look at, is that, I guess, a global outlook? Is that mainly focused on the US? Because I guess if we look at China, that hasn't experienced that same increase, probably because of other sort of geopolitical risks there as well. So does that, I guess it's hard for this to be taken into account, the geopolitical risks.
I think there are two things to say, Anthony. One is that one of the things that is always makes sense is to diversify gains. Markets rotate, so we're seeing the US, not surprisingly, being a leader. It always is a leader, and around this stage of the cycle, the European markets and the Asian markets do tend to get more traction. That's the case. The proviso, or what I would add as a caveat to that, is that one of the things I think this cycle has proven beyond others is that Wall Street is the global market for world equity investors in a way that it hasn't been in the same way historically. So if you want your global stocks, your brand names, your technology companies, you go to America, you go to Wall Street now. You don't bother, you don't play around in the UK market as much. The UK market's being eclipsed, but so are European markets by what's happening in the US. So I think you've got to make that caveat. But having said that, it does make sense to diversify to some extent.